The Milken Institute Global Conference is the culmination of the important work our centers do throughout the year and helps inform our agenda going forward. Each of you participating represents extraordinary expertise, an ability to mobilize significant resources, and a sincere desire to be a force for good. And for that, we could not be more grateful. It is my honor to formally acknowledge and thank the group of people who make this event and all the great work we do possible, our supporters.
Thank you for joining us today. And if there was any one panel topic that really captures this year's global conference virtual, it would be this one: common sense for uncommon investors. And as we focused on a title, a theme for this year, we all eventually concluded meeting the moment. And the 12 different tracks that we have at this year's global conference were really under the understanding that each of us will be judged on what we've done during this unusual period of time, a worldwide pandemic. The Milken Institute activities really broke into 6 categories, as each one of the center managers focused on their own areas of expertise, whether it be education, testing, prevention, treatment, cures, or economic safety nets from that standpoint. If there ever was a year that we were focused on those uncommon investors, it would be this year, as the stock market dropped quickly in March and reached all-time highs later in the year. And so today we are joined by Afsaneh from RockCreek, George Hicks from Värde, Neal Wilson from EJF, and Jonathan Sokoloff from Leonard Green, each with their own structures and their own companies. And I thought we'd first start with what one thinks is common sense. So, Afsaneh, why don't you start with us? When someone says common sense, what do you think?
You know, Mike, I think what is really interesting is your conference, which has been going on for a number of years, epitomizes the situation, because you have brought in health and education from day one into conversations with finance, which was not common at the time. But if you really think what is common sense, it is the way we live, right? It's the way we live. It's what we consume. It's what goals we have in our lives. And it starts with having education for our kids, having good health care for our families, and having enough income, so income equality, so that you can have a meaningful life. And financial sector is really a means to give this to a bigger part of society. So when we take a common sense and the pandemic now, it's really how do you run your firm, how do you run your life, and how do you do those two things consistently in a way that uses common sense. And I think you've been talking about this for a number of years.
So, well, thank you. And obviously, you couldn't have gone to a Milken Institute conference in the last 3 decades without hearing me trying to remind you that more than 50% of all economic growth can be traced to public health and medical research, the extension of life from that standpoint. George, when you sit down with your partners, what do you view as common sense?
Well, there's a couple things that we think about, but I'll go back to put it in the context of the times we're at right now. And March came, and we knew we were in the midst of a major economic cycle disruption to our lives. And as we think about common sense, there are two things we said. Is one, don't get too trapped in our own lane. By that I mean, obviously we're credit players. We think about the financial markets. But the challenges of this cycle in disruption were much bigger, and it called on us to really get a much better understanding of a lot of therapeutics, how the pandemic was going to play out, what it meant for our business that way. It called on us to, obviously, as Anna said, how we run our business, working remotely, the health of our employees, how do we communicate with them? And then importantly, and it's always part of our analysis, is understanding the government responses, which have been such a big part of it.
So it's interesting what you've pointed out here, George. 35, 40 years ago, people used to wonder, okay, what's M1 going to be? What's M2 going to be? Today, as investors, you're just as interested or more interested in what's happening with vaccines, antivirals. And I know each of the four of you are daily checking the Faster Cures tracker on 210 vaccines and 300 plus antivirals. Neal, common sense. As George has pointed out, your investors are about to call you. Stock market's dropping 30%. And as Kipling told us, how do people at your firm, EJF, keep their head when everything is falling apart around you?
Well, the watchword would be perspective, Mike. I think Afsaneh pointed out that, for example, the financial system has really been the means by which to respond to this from a financial perspective. And we've been saying that we're very fortunate that the great financial crisis took place before we were hit with a pandemic. We were fairly confident, having perspective, that the government was going to act in a forthwith way. They were going to pull out the old playbook, and they did exactly that, and they should be commended for it. But I think life has changed dramatically in the last 6 months. As you have mentioned, and as George referenced, I mean, every morning we talk about what's happening in the markets, what's happening in politics, but we start the meeting talking about how are therapeutics being developed, how are the vaccines progress coming, and you really need to reassure your employees that and your clients that you have perspective. And we've been very, very fortunate that we've had a doctor on our staff to provide that kind of perspective for our employees for many years. And then we've been very fortunate to be able to tap into some of our old colleagues who were involved in vaccine development and RNA technology in that space. So I think the watchword would be perspective.
So Jonathan, you have hundreds of thousands of employees in your various businesses. They're a diverse group. Take us back to the beginning and middle of March. What were the meetings at Leonard Green like?
Well, Mike, they're like meetings we've never had, and in our 30 years. But just taking a minute, I do want to thank you for including me on your panel. It's always a highlight for me every year. For the audience's benefit, I've been at Leonard Green 30 years, but before that I was privileged to work with Mike at Drexel, where we saw our share of cycles and drama. In fact, 33 years ago today was Black Monday, when the stock market fell 508 points, 22.6%, which none of us thought was possible. And we reacted, and we recovered from that. And we reacted here on COVID, and we will recover from this. But we'd never seen anything like what happened in mid-March. We have a portfolio of about 35 companies. We do all kinds of downside modeling. but we've never modeled no revenues for some period of time. So it was quite a period of crisis back in March. And what we did is we immediately convened a crisis all-portfolio Zoom call to convey to our portfolio companies how serious we thought this was, because we felt that some of them didn't quite get how bad it could be. And first and foremost, we focused on the human. You talk about on the human impact, and it was important for us to be leaders, and leadership is a very important quality to have, and a very important in a time of crisis. And we really tried to lead by example. It was a time of shared sacrifice for everyone, and we did a variety of things vis-a-vis our portfolio companies that were financial sacrifices on the part of Leonard Green to help our businesses. We set up a $10 million employee assistance fund funded by the partners of Leonard Green to help families of our portfolio companies negatively impacted by COVID. So we really wanted to connect with our companies and our people on a human level, because the toll financially and health-wise was potentially so great. And it was a time of survival. Conserve your cash, stop paying your bills, draw your revolver until things stabilized. And that was the message that we passed loud and clear. And I think our message of compassion, empathy, shared sacrifice, and leadership was very important to set the tone early on in COVID. And none of us knew how long and bad the economic crisis would be. We felt it could be very protracted. Now, it ended up being less horrific than we expected, and we can get to that as well. But I think how we started off COVID and the tone we set with both our investors, our own people, our portfolio companies, was very important and speaks to the culture and firm we've built at Leonard Green for over 30 years.
Jonathan, you also had an individual that was focused, as Neal discussed, on the potential health, medical breakthroughs, vaccines, antivirals, antibodies, immunology agents internally in the firm so that you could brief everyone. Talk to us a little bit about that.
Sure. We have a fairly substantial healthcare services practice. It's upwards of 25% of our business. And one of our healthcare partners began publishing kind of a COVID weekly or every other week newsletter, in his mind, gathering all the latest information and passing it on to our portfolio and internally, and some real-time information from the front. We have two particular investments that have a real window into what's happening in COVID. We have one company which is very involved in the clinical trials business and arranging and expediting and facilitating clinical trials to make them quicker and more efficient. We also have a company that is an outsourced manufacturer for big pharma and biotech, and they immediately geared into action and are involved in manufacturing several of the potential vaccines as well as the therapeutics. So that gave us a very interesting window into what was happening on the ground, on the science, in the laboratories, in the factories, and we felt we could give real-time information to our community, which was very helpful. Now, there was a lot of, unknowns, particularly in March and April. As the spring went on, we began to get more comfort from our sources that the scientific effort that was being mounted globally was unprecedented and what was going to bear fruit quicker than expected. And so we passed that along as well and sent out this series of regular emails to our community to keep people posted. And when we had for example, we've had quarterly calls with all of our investors, and we've had some people speak from these companies that give the real-time input about what's happening in the clinical trials, what's happening in the vaccines, how are they going. And first and probably most, when the vaccines come out, do these experts think they will be safe? Would they take them, and would they advise their families to take them? And the message we got starting in the summer, loud and clear, was that when they come out, you should take them, and that they will work. So those are some of the things we did that's a little bit out of the core competency of a money manager, to call on our contacts to spread the word amongst our community.
Afsaneh, March, they're calling you. Your responsibility to your investors. They're concerned about volatility in markets. How have you structured your portfolio at RockCreek to prepare in some way this diversification to protect you from this volatility? And how have you adjusted that portfolio over the past few months?
So, Mike, to step back, I think one of the things at RockCreek in our portfolio is that we were already investing in healthcare, including biotech, including healthcare delivery systems, including some early research. And it so happens, maybe by coincidence, by luck, that some of the companies that we were investing in, some of the funds that we had invested in, are some of the companies that are now in the second or third phases of the vaccine trials. And some others are involved in the delivery of these vaccines. But this was always part of our portfolio. So we had been investing in areas that both had high return and high potential return, but also were, in the sense of diversification, covering things like health sector, education, climate and clean energy, affordable housing. And what was really interesting, Mike, is that through COVID, while we were having these calls with our clients and investors, the interesting thing is that, for example, talking about affordable housing, that was the area which did so much better than typical, let's say, commercial real estate. And that was because of the way it was structured, because the people that we had invested with also took care of their populations. They had doctors on site always, not because of COVID, but pre-COVID. They had provided really good broadband service in their buildings, which meant that their population could continue working or their kids could study in their housing. And similarly with education, we had done a lot in long distance learning areas with a couple of the biggest education investors in the country. So those were all areas that did well. And as I mentioned on energy, we had been pushing towards more clean energy. It happens to be my old background from when I worked at the World Bank. We were doing renewable energy 20, 30 years ago, when it was still not very economic, but promising. And so these areas ended up being really positive areas post-COVID. And so with our investors, we had really good discussions. I think the big question when March happened was, at this point in time, what do you do? A lot of people were very worried. They were holding back in terms of getting into the markets. And you had to be very careful, because depending on which day you went into the market, there was like a 10-day period where you could be losing a lot or making a lot. But our philosophy was, if you look longer term at what is now, people are not calling these new companies, but I don't think you've been calling it new companies. We've not been calling these new companies. This new way of life that we are having, where we're having the meetings that we're having, the way we're having them, is going to be at least another probably year, if not two. I think you talked to my friend Peggy Hamburg, and vaccines will be there. But from at least some of the nonprofit work I'm involved in, 50%, 60%, effectiveness for the vaccines. A lot of other drugs are coming up that will help. But it's not like we're going a full force into offices or into big stadiums or big concert halls 6 months from now. It's going to be a gradual process. It's going to be more like a year, maybe a little longer. And so as life is changing, it's really important to be investing in the companies that will benefit from this. And these are not just the big five, that obviously did a lot better than the other 495 in S&P, but it is the companies of the future.
Now, what about emerging markets? And one would be concerned that they might get hit harder. The companies might not have access. How have you approached emerging markets during this period of time?
So, as I mentioned, I've worked at the World Bank for a number of years, and at RockCreek, just like you, have done a lot in emerging markets. Again, one of the biggest areas we had emphasized in emerging markets was the health sector. Health sector in emerging markets has been only 2% of their GDP. So compared to us, where it's 16, 17%, depending on how you want to measure it. And what we did was that we had over allocated in health sector, and we have continued to do that. If you look in emerging markets, they are a tale of two cities. You have China and North Asia that have continued because of their history with pandemics, and they're not being shy to wear the mask. They're having all the not just the medical and the tracing systems in place. There are now companies in China, for example, that can test 400,000 people in one day. That's the kind of testing they're doing compared to other countries. And we had been investing a lot in North Asia. Now, what is interesting as we speak, Mike, is in Latin America, which was one of the laggards, and we saw Brazil was obviously doing particularly badly. India was in South Asia not doing so well. In Latin America, now we're seeing, as they're getting into their different seasons, tourism is starting to pick up. So you're starting to see some elements of life come back in terms of consumer goods and some tourism, in addition to the education and health sectors that we talked about. I think the thing that I'm really, really concerned about in emerging markets is that disparity between different emerging markets and places like Africa, where we might have lost at least 10 years of what we did in development over the last 10 years. Similarly, in parts of Latin America, where we might really be falling behind. So I think these countries are in very, very different places. If you're in North Asia, you're actually ahead of us. And if anything, while we're having these conversations, they're developing their digital currency, they're developing their banking system, they're developing how to get vaccines distributed to hundreds of millions of people. And so in those ways, they're ahead, while other emerging markets could fall behind a lot.
George, when I think of the ultimate international company, I think of you. Headquartered in Singapore and Minneapolis, investing in India and other places around the world. How did you approach what was unfolding with the pandemic, and how have you managed the company over the past 6 to 7 months?
Well, there's a couple of things to come to mind. One is, as you know, Mike, we're a global business, and we very much manage our business in an integrated fashion, both our book and our businesses overall. And so my co-CEO is in Singapore, and we have deputy CIOs in Minneapolis and London. And so we really bring everything together. And that's an important point. You know, the theme here is common sense. And the common sense piece of it really is heightened by bringing so many different perspectives to bear on it. And so what we quickly realized were a couple things. I'll harken back to the fact that we are a credit firm at heart. And so as a credit firm, we look back and we're also cycle aficionados, okay? And so we quickly realized that this cycle had some similarities to past cycles and had some differences. And the differences we've talked about a little bit a few minutes ago, about how we had to become experts understanding therapeutics, much better at understanding the government response. But we also recognized, like other past cycles, it became fairly clear to us that we had an opportunity set in front of us. And historically, these opportunity sets start in the public and more liquid markets. And so that's really where we focused as a firm and are investing in investment grade, fallen angels and the like. And we know it's part of a process that's going to unfold over a few years. And so we've kind of gone through the first 6 or 7 months of it. And now we're starting to shift to more private opportunities, and ultimately there'll be more of a distress cycle. Now, as we look at it globally, and by each office, there are just two other things I want to point out. One is you have a much different impact in terms of government stimulus. So in the U.S., it's been a big time. We've stepped up monetary and fiscal. I needed to do it, otherwise we would have had probably a depression. But that's been a big factor here, and it's driven our market here. Europe was a little behind us, and they were a little, some parts slower, but of course you've seen Germany and France step up. And then as you move around the rest of the globe, a lot of places, like Afsaneh said, don't have the same resources to step up financially to respond in some of the more emerging markets. And that's impacted the opportunity set. So even though we have a capability to invest equally in all geographies, what we've seen is that most of the opportunity set for us has been in the U.S., 60 to 70% of it, because those are where the large public markets are. And then it's followed by Europe. In Europe, as you know, and you often say, is a bank debt market, not a bond market. And so the price adjustment is slower. The transacting is a little bit slower. And then Asia is a little different case, is much smaller public markets. And so there we're starting to see some transacting on the private side of things. So there is the common pandemic that hits all of our geographies equally. Each country, of course, has its own ways of dealing with it, but we've seen the response in the markets vary quite a bit by the three major geographies.
George, let's pick one area of the world, one country, India. It's an area that your firm, Värde, has enormous knowledge of, had predicted many of the financial problems that were going to occur prior to a pandemic. How are you viewing the country that someday will have the world's largest population, one of the two countries in the world that's moved the most people out of extreme poverty over the last 20 years, has moved to educate girls, and now dealing with this pandemic? How do you see India unfolding, and how is your firm responding?
Yeah, thanks, Mike. I mean, India is a big focus for us. It's an area that we've said that we're really going to put our resources into, and so we've opened offices there, hired folks, and of course that's an important piece to taking advantage of any opportunity like India. Is you have to have a presence on the ground. You have to be local, as it all works there. And as I think about India in the longer term, two things come up. I mean, one is optimism for the long term. We think they're doing a lot of things correctly. It's going to be a great story over a period of time. But the second point is there'll be some bumps along the way. And as we get to the shorter term, there's a bit of a cautionary piece. I think the pandemic is hitting India in a tough way. I mean, it's hitting everybody tough, but we've got to work through that a little bit. And then as we look at the opportunity set, we're a little bit at a pause, and then it's going to take off, because they had a big supply of bad loans going into this crisis. Those are still there. There had some disruptions to the financial system. But what it's going to create is a very interesting set of opportunities, particularly in the real estate markets, as well as an ability to do some direct lending supported by hard assets. So long-term optimist, certainly medium-term, have to be a little bit cautious as we go forward here.
So Neal, probably more than any other firm in the United States, you have been focused on small and medium financial institutions, minority institutions. And as you saw things unfolding, and we saw in just a few months, 40% of African American businesses had shut down, and the government has had a very difficult time of getting capital into minority or lower income communities. your preparation at the firm and your expertise in this area probably puts you in a position more than any other firm to work with the government to try to figure out how do you get capital into these areas. A lot of times over the last few decades, we've talked about food deserts, communities where there isn't a grocery store. But as you know, there's these financial deserts in America where there is not a financial institution in the community. Talk to us about how you see this unfolding in March and what your firm has done and how you've interacted with the government since then.
So Mike, thank you for bringing this very important topic up. And I know it was a subject of a separate panel that my partner Manny Friedman was on. But we went immediately into action. We're a regulatory event-driven firm. We're here in DC. And we worked with both Democrats and Republicans and our lobbyist friends to talk about how can we use some of the old tools that were used in the great financial crisis of 2008, 2009 to really help what we saw that COVID really revealed, which is there's incredible inequities in our society. And as you indicated or analogized it to food deserts, there's really financial deserts. And most of the banks, minority-owned banks, MDIs, those and CDFIs, which are community development banks, tend to be on the small side. And we looked over the last 5 years prior to the pandemic, and only 2 of those minority depository institutions had received equity investments from outside firms. And in terms of debt, issuance of debt, it was 0. And we're talking about hundreds of institutions. So we looked at it and we said, look, the way to have a sustainable change is to have the government not just, as it typically does, require big banks to put deposits into these institutions. It was rather to provide a mechanism by which there would be inexpensive capital supported by the government to allow these banks to get equity investments from risk investors, from impact investors. That would be the catalyst, would be the government's access to capital. And we use the Public-Private Investment Program, PPIP, as a model. And so we've been working quite hard on that. And the good news is that there is bipartisan support. And we have proof of that it'll be sustained even past the election. In whether there is in the next 48 hours there is a stimulus package or not, no matter who wins, whether there's a blue wave or the Republicans hold the Senate or Trump wins and holds the Senate, it doesn't matter. Any of those 3 scenarios, there will be a stimulus package, and it will have bipartisan support for helping these small minority depository institutions. And we're very encouraged by that, because sadly, when we looked at the Paycheck Protection Program, the PPP program, which was part of the first stimulus package and the second, unfortunately, the MDIs were the least likely to use that program. And some of that has to do with technology, the lack of technology that feeds into the Small Business Administration tech platform, which was used to send out the capital through the PPP program. And so these small banks need capital. If they don't have capital, they can't do the technology spend. If they don't have outside investors like us and impact investors like us going in, they will not have the mentorship that they need to really grow and become long-term influencers in their communities. We have been encouraged that the call to arms has been well received, and sadly, the pandemic, has been as harsh as it has been on society, but it really has been a catalyst, and we think that we're very heartened by that. In terms on the investing side, it's really been an education process. The small banks really have withstood well this situation of extending loans and forbearance. And what we're seeing now from an investment standpoint is a very attractive situation where the debt issued by banks is been considerable, particularly by the big banks. They trade closer to treasuries than any other sector but technology. Yet the equities trade or have traded down more than any other sector but energy. So just think about that dichotomy. So we have been educating our investors about the need to think about financials from an equity standpoint and from a debt standpoint. And at the same time, we think that this, unlike the great financial crisis, which was a bank problem, this has not been. And we think that's a factor that leads us to be encouraged that we can have sustainable change at the MDI level.
Mike, may I say something?
Sure.
I think EJF has been really a leader, I think, as we just heard, and one of very few who's doing what we just heard. I think the big problem is both in 2008 and now, the government can only push money through the biggest of institutions, be that banks, asset managers, the largest. And those do not necessarily, as we just heard, have the good connectivity with minority businesses, whether it is Black and brown businesses, women-owned businesses, or others. And so this problem needs to be really resolved from a bottom up. I mean, just think about all the financial tools that have been created to deal with a lot of issues. A lot was done by multilaterals in emerging markets. You touched on emerging markets before, so that smaller companies, mid-sized companies, and lower income people could get access to banking services and to loans for their small businesses and medium-sized businesses. It might be a good time to bring some of those tools that already exist into the U.S. because the structure that we have and the structure that the Fed has used in both occasions in the last 10 years has had deficiencies because of the fact that it goes through these largest institutions.
No, and Afsaneh, I think you're right. I'm sorry, Mike, go ahead. I apologize.
No, go ahead. Go ahead, Neal.
Well, I was going to say, Afsaneh's point is very well placed. The encouraging thing is that, again, I hate to say that COVID was encouraging, but it has accelerated some trends that in the adoption of technology. For example, during the last 6 months, mobile bank usage in the United States has gone up 85%. And the use of technology by the smaller banks, not just MDIs, but the whole universe, the uptake has been considerable. And loan applications are now, instead of taking 35 minutes, are taking as quickly as 5 for PPP loans. And about 63% of the loans were done by the small banks. So I do think there's some encouraging things that COVID accelerated. The last thing I would say is Bank of America deserves a little bit of a shout out because instead of just putting money into deposits, which really doesn't do a bank, people don't understand, doesn't do a bank very good. If you get $1 in deposits, you can only lend out 80, 90 cents of it at most. If someone invests $1 of equity into your bank or $1 of debt, you can lend that out 10 times, $10. And so that's what's needed. And Bank of America, instead of putting deposits, just went out and said they were going to put $100 million into minority depository institutions in equity. And I think that is very commendable. And that's what we're trying to promote in terms of the legislation in this fourth stimulus package, whether it's before the election or after the election.
Jonathan, I want to go to you if I could, just for a moment. You know, whether it's George, who serves and not just an investor in Värde, but a mentor, and he goes into these various markets and structures, whether it's Neal, who talks about how you have to mentor these small businesses. Your firm had an unusual, very successful 30-year record in managing businesses and obviously playing a mentoring role in some sense to these businesses. And the fact that you had seen so many cycles over the last 40 plus years has prepared you. Take us and maybe walk through some specific situations of what occurred, what the responses were, and how you've dealt in particular in any particular industry.
Sure. As I said, it was a frightening time and an unprecedented time in March and April, and I think some of our companies were just a little bit like deer in the headlights, weren't exactly sure what to do, and we were very aggressive in recommending and implementing a drastic action at that time. There was, as I mentioned, shared sacrifices. So most of our senior management teams took pay cuts or eliminated their pay. At the same time, they were laying off thousands and thousands of people. It was like you're an old small business. You looked in your drawer and you said, what bills am I going to be paying in the next few weeks? And you looked at the bills and said, well, maybe I won't pay all those bills. And one of those bills was rent. And we had extensive discussions throughout our portfolio, as well as with landlords, about withholding rent, particularly when a business, the site was closed, and just creative ways to husband cash. Cash was king back in March and April. There's an old saying: it's okay to lose money, just don't run out. Now we had resources if we needed to put into our businesses, but we were very fortunate that none of our businesses needed cash from us in that time, even though we were ready to give it. So people did things they never had done, not pay their landlords, not pay other service providers, take big voluntary pay cuts, stop all CapEx, and we were really pushing them at that time to do this, and whether that was our healthcare services business, our retailers, we have a lot of services business. We're in the car wash business, we're in the body shop business. A lot of people weren't driving their cars back in March, April. So just crazy results. And we put in a sheet. We have a sheet that we tracked every company's cash every week, red, yellow, green. And if someone was looking like they were getting towards the red, we implemented more changes to make sure they had the cash. And so it was exhilarating, it was exciting. It kind of has a pretty happy ending, but it was frightening, a very, very frightening time that I've never seen before. And, the interesting thing is, and I can get into this now or later, how unexpectedly rapid and strong the recovery has been across many businesses across the country, with some exceptions, of course, after the depths of despair in March and April.
So, Jonathan, take us forward 7 months and talk about what happened with your car wash business.
Look, it's somewhat, you can sit and you can, read the press and look at all the data and concoct a very negativist view and depressing view and we're not economists. We can't predict the future, but we get 35 reports every Monday on how our businesses are doing. And as we sit here today, April 19th, business in most of America is quite good. Now, I'm not talking about hotels or travel or oil and gas. We're not in those businesses. But if you're kind of in the mainstream economy, many of our businesses have returned to pre-COVID levels or higher. So people are washing their cars as much or more as they used to. People are going to the dentist as much or more as they did pre-COVID. We have a litigation services business. Litigation is booming. We have several businesses that are tied to the home. People are spending money on their home. We have a business that organizes your closets in your kitchen, booming, puts window treatments up, does remodels in your bathrooms or kitchen, fixes your air conditioning. We have a business that sells jewelry, very strong. We were in the crafting and sewing business early on in COVID, selling fabrics to make masks, very strong. And of course, the natural business to boom during COVID is laser hair removal, which was closed for 3 months, and the minute they opened, they were operating at about double the level of a year ago. So between reemployment, the stimulus, we don't always know why, but we do know what the data is. As we sit here today, I don't want to. I just want to, add a tone of, things are okay to all the negativism. Now, things are okay in many sectors, in many geographies. Will it continue? We don't know. I mean, the old stimulus kind of wore off, and it's continuing. We feel we need another stimulus. When the stimulus checks came in May, June, July, we saw a shifting in consumer buying patterns and some consumer durables. People were spending their checks, but it's shocking how many businesses have returned to normal when intuitively you would think there's no way. And so that makes us feel a little better. We're always nervous about the future because most of our businesses don't have strong, accurate, predictive capabilities. They can tell you what they did in business yesterday. They can't tell you with high confidence what they'll do tomorrow. We even have a business that supplies independent restaurants. It's a cash and carry business. There's all these gloom and doom reports about half the restaurants are closing. Again, we don't know why this business is running flat to the same revenues they ran last year. They don't supply chains, only kind of family-owned independent restaurants, which are somehow scrappily running around doing business. So those are the reality and the facts from the street, and how that relates to the bigger economic picture is not necessarily our place. Another interesting caveat is there were massive cost reductions implemented by many companies in the spring, both in people and just generally ways they ran their businesses, expecting a long and deep recession. And while there's still plenty of troubles out there, many companies have seen revenue recoveries stronger than expected, but they've seen earnings recoveries leading the way, exceeding the revenue recoveries, because costs were cut so much and costs have not been put back in. And while there's been massive rehiring, everyone has not been rehired, and in particular, there's, in many cases, middle management in our companies has not been replaced. These are not the $15 an hour hourly workers. These are people making $100,000 or $200,000 a year. Many companies realized they didn't need as much of that middle management. And for those employees that are unemployed, it's brutal because an extra, $600 a week from the government, while it's helpful, is not going to make the difference if you have mortgage, car payments, tuition payments, whatever. So I think you're going to see strength in profits, but some protracted unemployment in some middle management. And we'll see what new and creative businesses are happening out there that are hiring. Many businesses are hiring. Is that enough hiring to offset some of the damage done from the massive headcount reduction that American business went through in the spring?
George, you wanted to make a couple points. I'd like to come back to you.
Yeah, I maybe tie together a couple of things that my panelists all said here. I agree with Jonathan that there are a lot of ways that the recovery has been surprising. But on the other hand, there's clearly a disconnect in a lot of ways between economic fundamentals and how the market's responding. And I think part of that reason is something that Neal and Afsaneh referred to, and that's the mechanism to get support down into the system, if you will. And so we've had massive monetary stimulus, fiscal stimulus. And not surprisingly, lots of times that stimulus goes into asset pricing. And so you've seen, the tech stocks. I mean, NASDAQ's up 25%, S&P's 10%, but it's down 3% without tech. And so we've had, flows of funds into those areas, which hit pricing. And so the reality, and you nicely had put up the slide earlier, is that the recovery we have here is the K recovery. We've all had to settle on which letter we want to use, so I'm a K person. You can call it the 90% economy or the two-tier recovery. And while you could try to make a bullish case for next year. There's clearly COVID impacted industries that are going to continue to suffer here. I think an interesting case in point is commercial real estate. So if you think about commercial real estate, things like industrials or multifamily are doing very well, but others, hospitality, office, and of course retail, which faces more of a secular problem, are in trouble. And even when you have a recovery of some sort as we get into next year and beyond, stronger if it continues, you've got the secular challenge. How much office space are we going to use? What's going to happen to business travel and the like? And so we really have a dispersion. My slide 10 captures that a little bit in the high yield market, where you can see that some sectors are still cheap by various measures, what you might call the COVID impacted industries. And the fact of the matter is there's still a default cycle ahead. You have a recession, eventually defaults get above 10%, or at 6%. And so that piece is still lingering out there that we're going to have to play through in the months ahead.
Thank you, George. In closing, I'd like to go around with maybe quick responses. What was unexpected from that standpoint? Afsaneh, why don't you start us out? You planned, you met, your days at the World Bank gave you a worldwide perspective. What has been unexpected for you?
I think on the positive, the human resilience, which we've talked about, and how people came together to help each other, to help their communities. I think that was really wonderful. Then on the negative, Mike, I'm still shocked that as of today, if you wanted to buy N95 masks, if you want to buy, basic cleaning products, we haven't been able to respond. That's kind of unusual for the U.S. economy. George,
how would you respond to that?
Well, the two things, and I'll take two as well. One is I do have to admit that this is going to take longer than I thought. I hoped that by the time we started to turn the calendar, we'd be back to normal, and it's hard to see that that's going to be the case. The other side, though, is really just to call out the positive developments that are going to come out of it, the silver linings. And certainly one of those that's come up a lot in this conference is what the future work looks like, and the fact that we've learned how to use technology better, and we're going to introduce more flexibility into the workplace, which I think ultimately is going to be great for all of us and the people that work with us.
Thank you, George. Neal?
Well, I think in the financial sector, the proliferation of issuance of debt has been staggering. And it's not only the big banks, which, as I mentioned earlier, they're issuing debt. The only sector tighter to treasuries is technology. But it's also been in the small banks, again, with the notable exception of, unfortunately, some of the MDIs and CDFIs. It's 4 times the level that it was last year, and you had a pandemic in the middle. So that's a big surprise. The other thing is that we haven't, even though COVID is shown some of the inequalities in society, there's some areas that really need focus. And I think Afsaneh had it in her slides. In the ESG area, we think that we've been an investor in the opportunity zone space, and we're about to close our first fund, and we will do a second fund. We think there's really an impact component to it with respect to, kind of the entry-level homes. Prior to 2008, entry-level homes, which is defined as about $250,000 per year or per house, was 75% of the homes, and now it's less than 25%. So that's a problem. We have a supply-demand mismatch for the younger people in our society, and I think the last thing I would say for positive is the U.S. Is an innovator still in certain areas like capital markets. You can call SPACs. The special purpose acquisition corporations, you can call them a fad. We don't think they are. We think they're structurally changing the market. Over 50 or almost 50% of the IPOs this year were SPACs. And the interesting thing is only 99% of all SPAC dollars are U.S. companies. And so last week, the London Stock Exchange talked about maybe they would allow SPACs to happen. So the U.S. still has an edge in certain innovative areas, and that's been a big surprise.
Jonathan?
Well, you talk about, what was the surprise here, and the answer is everything was a surprise. None of us ever anticipated anything like we're going through. But, the name of this panel, common sense, I think permeates, a lot of what's happened in COVID and differentiated some of the winners, from the losers. And we continue to be so inspired and impressed by companies and people's nimbleness, adaptability, willing to change, willing to try new things, scrappiness. And it's those kinds of qualities that are kind of common sense, how to react to a crisis, that have really borne tremendous fruit in this crisis. So we've all seen the dramatic acceleration of whether it's the shift to online, where businesses that we have that were very low online percentages probably are now where they thought they would be 5 years from now. Demographics that are not used to being online shoppers are now online everything. So there's been this huge acceleration of change. There's some exciting aspects of it to it. There have been some great places to invest in to take advantage of some of these changes. We've invested almost $5 billion since COVID in a whole variety of situations that we think will thrive however long COVID lasts and post-COVID, because some things have just changed forever, and a lot of that is going to be a positive. So, use your common sense, see how people are reacting, how they can really operate in different environments, and you'd be surprised how successful it could be.
I want to thank all of our panelists today for joining us and providing us very interesting perspectives. I'd say 2 points in closing. One, to expect people to do nothing during a crisis is not going to occur. And as Neal pointed out, the experience of the financial crisis, which was based in finance, not a pandemic, the fact that it occurred first allowed governments around the world to move earlier and faster to shore up the economy. Once again, I want to thank our panelists for their insights and congratulate them on what they've been able to achieve at their firms. Thank you very much for joining us.
Thank you, Mike.
Thank you.
Thank you.
Thank you.